Hey everybody, Brian Shannon here. It is Sunday, the 8th of November, 2015, and sorry for the audio problems, but let's go ahead and take a look at the week that we had in the market. The S&P 500 did finish with a gain this week. We can see here's where we finished out last week, just above that rising 5-day moving average. And for the last 3 days, we've seen a little pattern of lower highs and lower lows. The thing that gets me a little bit concerned on the intermediate term time frame is that we do have that the lower highs and lower lows, obviously, and we are right now pretty much at a pretty flat 5-day moving average. If we stay stuck below, I would say 210.5, then I think we want to treat this market a little bit more cautiously next week and think about the possibility that we start to see a little bit deeper correction than we've seen in a while. This market, since rallying off those lows, obviously we've had this massive run here, and we could draw this trend line and say it's been broken, but is that trend line the proper one to draw, or is this more the essence of trend here over the last couple weeks? And I think that this is the essence of trend. So, I think we're in a neutral zone as long as we're below 210.5 down to about 207.5. Now, obviously, if you're a day trader, going down to 207.5 would be a nice little day trade for 1% or so. But right now, again, we've got, on the daily time frame, we've got a bullish look. We've been riding this rising 10-day moving average. We've also got a rising 20 and 50-day moving average. If we look at the year-to-date chart, here's our volume weighted average price year to date. So we blasted right through all these prior levels that were potential resistance. And again, that's why I always emphasize potential levels of resistance. There is no resistance known until after the fact. If we take a look at a trend line, that kind of looks like this off the peaks for the year, you could argue that maybe that's going to be an issue for resistance. But I prefer to look at it as right now we're kind of more in a neutral zone. But if we break down below that 207.5-ish area, then we are likely, I think, to see a pattern of lower highs and lower lows below a declining 5-day moving average. And that would say that in the intermediate term, we need to correct price-wise. So far, this correction is turning into a little bit more of a time correction. So it's nothing to be concerned about, but it is obviously something to be aware of after the market has had such a big rally. Realistically, it's holding up very well. So even if you're looking to become bearish, the evidence certainly isn't there. And if we were to break below 207.5-ish, then I think that you're not likely to see a big pullback. Perhaps we get down towards that year-to-date volume-weighted average price, and that could be a decent little pullback. But the buyers have been very impressive in this market over the last several weeks here, over the last month and a half or so. Onto the Nasdaq, we have this market that closed at not all-time highs, but highs for the last decade or so. Actually, I guess on a monthly closing basis, if we were to close here, this is an all-time closing high. So, obviously we're only 1 week into the month, but it does put this in perspective. The strength of the Nasdaq here has been just phenomenal. After this gap higher, it has done no such thing as all gaps must get filled. A lot of people say, hey, I'm going to short it until it gets, fills the gap. And gaps do get filled, but sometimes not for a year or 5 years, 10 years before a gap will get filled. So don't get sucked into, hey, I'm going to short strength and wait for a gap to get filled. Looking at the intraday time frame here, you can see we've seen the same thing. Just a kind of a grind lower here the last couple of days, but for the week we had positive movement. So 113.5, 114 is going to be a key level that we want to see hold as support first thing in the week. We can also take a look at a volume weighted average price since the event, that is since this gap, and you can see that's right now at about 113.75. So that kind of further emphasizes the importance of 113.5 to 114. By the way, last week I had suggested I was going to be using new charts. That got delayed by a week, but I'm going to use different charts next week, and you're going to see a much, much cooler way of representing that volume weighted average price. So easy to do, and in a very inexpensive charting program. So it's just, I'm really looking forward to sharing that with you. anyways, onto the 10-minute time frame. We've got a little bit of chop in here in 113.5 to 114. As long as we remain above that, we're kind of neutral for right now with an upward bias because we have a rising 10, 20, and 50-day moving average, and we're at all-time closing highs if we were to close here on the monthly basis at least. So we're going into the week expecting a little bit of just cautiousness. And we're getting through most of the earnings reports, and there are, of course, individual stocks that are just imploding, but we're seeing a lot more of them, in particular some of the big ones that are doing really well. If you think about stocks that are in downtrends, stocks like FireEye, that's what you're going to expect to see happen most of the time in stocks in a downtrend. It's got a sexy story, but only price pays. FireEye is the new triple D. Basically, these are stocks that have great stories that everyone loves. Everyone wants to buy them on pullbacks, but if you look at, for instance, Triple D over the last several years, we continue to be in a horrible decline there. I'm not suggesting that's going to be the case with FireEye, but clearly, FireEye, the sellers are in control, just like they're in control for stocks like GoPro. And, the sellers don't stay in control. As you guys know, I'd been talking bearishly for a while about Alibaba, but when a stock gets back above on Alibaba, for instance, when it gets back above that 5-day moving average and the 5-day moving average is advancing, then it's innocent till proven guilty on the time frame that you're looking at. So, for instance, on Alibaba here, when we look at the 5 and 10-day moving average, we've had this 5-day moving average advancing for the entire advance here. So we never made a lower high below a flat to declining 5-day moving average, and we're still not there. If it breaks below this level, perhaps a little bit further pullback in Alibaba, but you have to be able to be willing to change your mind, to be flexible and listen to the message of the stock. Even over here, when we had a declining 50-day moving average, as I always say, we expect that they will decline, but it doesn't mean we sell short. We wait for evidence that the sellers regain control. And in that period where it broke the 50-day moving average, we broke down below the 5-day moving average, but we didn't see a pattern of lower highs and lower lows below it. A pattern of lower lows and lower highs below a declining, flat to declining 5-day moving average is what gets us bearish on a stock or on the market. And then the Russell 2000 this week, we saw that breakout continued here. So we had this breakout. It shook a little people out, some doubters in there, but we've got a rising 10, 20, and 50-day moving average in the Russell 2000. So in here, of course, we saw the breakdown. And last week we were talking about getting back above the this level right here would get us bullish once again, actually 116. Let me just erase that. 116 we were talking about would get us bullish, and we did get back above that level, and we pulled back to the rising 5-day moving average. The 5-day moving average is still advancing, so the Russell 2000 has changed to being the stronger group this week, and yes, this is a potential level of resistance, but as we've seen with the S&P 500 and all these other markets, these potential levels of resistance are just, it's dumb to sell short there because you see the potential for resistance. We have to anticipate all potential scenarios and wait for price confirmation before we actually participate. Anticipate versus participate, very different. We need evidence before we participate and take an actual position. So the buyers are in control of the Russell 2000. This will be the most important level for it to hold next week, 117.25 to 118, and we would expect to see continued movement higher in the Russell 2000. We are, coming into a potential level of resistance here with the year-to-date volume-weighted average price, so that's something to be aware of. It's nothing to sell short or take action against unless it gets up there, shows a pattern of lower highs and lower lows below a flat to declining 5-day moving average. Sometimes people, get confused with that message, it seems, but you have to be flexible and listen to the market. That's why I make these updates every single day for subscribers, and we get those subtle nuances that you don't get just by looking at a video once per week. A subscription for bronze is, I think it's $179 a year, maybe $199. I really don't even know, but it includes the S&P 500, the Nasdaq, the Russell 2000, semiconductors, biotechs, every single day after the market closed. The semiconductors are kind of just consolidating in here. They've been very choppy in this area. So right now, the key support for the biotechs is down at about 53.50 to 54.75. As long as we remain above that, I look at the semiconductors. Intermediate term is neutral because we're consolidating and we're seeing a lot of volatility in here. And to me, that's a market to avoid until it shows better evidence that the buyers are regaining control. Better evidence that the buyers are regaining back control would come up here. Now, I wouldn't want to buy just as it goes straight above that. Instead, the preferred scenario would be it rallies up to that, pulls back to the rising 5-day moving average, and then is to break out. If it was to do it that way, then you could buy with a stop underneath the higher low at the rising 5-day moving average. So again, it's about anticipating and waiting for price confirmation before I actually participate. Biotechs pulled back a little bit this week, but they came right to the 50-day moving average and are finding support right there, which is kind of surprising when you look at the continued action in some of these biotechs. For instance, INCY, which I had posted a chart on Friday, this is just a schizo stock. You have to understand the personality of the stock, and does it make sense to you? A stock like this, to me, just is too unpredictable. Yes, you could look at shorter term time frames and maybe see some more logic to it, but when you see a biotech that's trading off of news, and even before that big breakdown on Friday, that's where it made the lower low below a flat to declining 5-day moving average, and it got smushed on that. So we continue to see that VRX is a big problem for a lot of people, and one particular hedge fund manager who, for me, seems kind of easy to root against, a cocky guy who thinks that stocks like Herbalife are going to zero, and that call was made 3 years ago at this point. His call for Herbalife to go to zero was made over here. That kind of marked the low of the stock. Anyways, back to the biotechs, without making fun of people, because everyone makes mistakes in the market, but you see these gigantic mistakes with people with giant egos, and it's amazing that people continue to keep their money with them. The biotechs are trying to find the support near this 300 level and this trend line from the beginning of 2013. We are below all these longer term moving averages, which says we have a highly suspect on these rallies, and we're fighting this downtrend. But you have to look, if we clear that up, we're holding this level right in here, which was the prior resistance. So the resistance down near 320 to 325, as long as that continues to hold, it appears as though the buyers are trying to regain control of the biotechs. But in the intermediate term, we're a little bit neutral in here because we are below that 5-day moving average. The 5-day moving average is advancing, and we would have to break down, I think, and stay below 324-ish to really think that this market is going to fall back down deeply. So I would say for now, you kind of avoid the biotechs until they can get back above and hold above about 335 or so. Let's take a look at Apple quickly. Apple is holding on to its gains. It is below this 5-day moving average, which is still rising, but for now it seems as though it's just consolidating a bit. It's consolidating after, above the volume weighted average price year to date. So that's an important level to be aware of. I think that you want to look at it and say, as long as it's above that volume weighted average price year to date at about it's about 120 and a quarter, that you give the benefit of the doubt to the buyers for the longer term. But what we're dealing with on the upside is a little bit of potential for the resistance right up in here. So Apple is still a stock that is probably best for swing traders and day traders, but as far as investing goes, I think that it's got too much potential for resistance to work through up in here. But if you're long, then know where your stop is for the certain time frame that you're particularly invested in. Thanks for tuning in. We'll do this again next week, and I promise I'm going to have that new charting package and let you know all about how you can get involved in it for $40 a month for real-time data. It's a great deal. This Realtic is $300 a month.